If your mortgage is renewing in 2026, your payment is about to jump by an average of 24%. That is $622 more every single month, and over a million Canadians are walking into this without a plan. Here's the cause and effect nobody warned you about. In 2020 and 2021, you locked in at 1.5 to 2.5%. The Bank of Canada then cut rates, then hiked them, and now sits at 2.25%. Your renewal will be at 3.9 to 4.5%. Same mortgage, bigger payment. And today's data says 39% of you will dip into savings to cover it. I'm going to walk you through exactly what's happening, why it's happening, and the 5 moves you can make right now to soften the blow. Even if your renewal is 6 weeks away, if you've never renewed a mortgage before, this is the video I wish I'd had. During pandemic era, rate cuts pushed Canadians into a 5-year fixed mortgages at historic lows. Then, those exact mortgages are renewing right now. 60% of all Canadian mortgages renew in 2025 and 2026. The math is brutal. A $500,000 mortgage at 1.99% costs about $2,115 a month. The same balance at 4.1% costs about $2,650. That's $535 more every month for the next 5 years. Let me make this real. Picture Mark and Lisa in Edmonton. They bought in 2021 at the peak of pandemic. $480,000 mortgage, locked in at 1.89% because that was the deal of a lifetime. Their payment was $2,005 a month. They budgeted around that number. They planned vacation, TFSA contributions, a home reno, all based on that $2,005. March 2026, the letter arrives. Renewal rate 4.15%. New payment $2,591. That's $586 more a month. $7,032 a year. They didn't get a raise. Their groceries cost 20% more than in 2021. Their property tax went up, and now this. This is not a fringe case. This is the median Canadian homeowner in 2026. And the reason it hits so hard isn't just the dollar amount. It's that nobody budgeted for it. Nobody ran the math in 2021 because the rate environment made the math look impossible. The Bank of Canada's own research shows that households who locked in at the lowest pandemic rates were disproportionately first-time buyers and younger Canadians, exactly the people with the least financial buffer. Move 1. Get a rate hold 90 to 120 days before renewal. It's free and most lenders honor it. If rate drop, you take the lower one. If they rise, you are locked. Move 2. Shop. Your bank is counting on you to auto-renew. That renewal letter is almost never the best rate. Brokers will pull from 30 plus lenders. Move 3. Extend amortization. If you are 8 years in on a 25-year mortgage, you can sometimes restretch back to 25 or even 30 years. It costs more in interest long term, but it buys cash flow now. Move 4. Variable versus fixed. With Bank of Canada potentially holding flat or possibly hiking, variable is risky, but a 3-year fix gives you a reroll in 2029 when rates may be lower. Move 5. Lump sum prepayment before renewal. Most mortgages let you pay 10 to 20% of the original balance penalty-free. Doing this right before renewal lowers your renewed payment. Let me slow down on the rate hold because this is the one people skip and then regret. Here's exactly how it works. You call your current lender or a broker 90 to 120 days before your renewal date, which for most people renewing in 2026 means you should be making that call right now. You say, I want to lock in your best rate for renewal. They give you a rate. It's free. There's no obligation to use it. Now, if rates drop between now and your renewal date, you take the lower rate. If rates rise, you're protected by the rate you locked. It is a one-way bet in your favor. There is no scenario where doing this hurts you. The only risk is not doing it. On shopping, I want to be specific here. Your bank's renewal letter is a first offer. Banks know that 70% of Canadians sign that letter without negotiating. They are counting on that. The renewal letter rate is priced for people who don't shop. When you go to a broker, they submit your application to 30 or 40 lenders simultaneously. You get competing offers. Then you go back to your bank and say, I have an offer at 3.89%. Can you match it? Most of the time they do. You didn't have to switch a single thing. You just had to make one phone call. The average rate difference between the auto renewal rate and the shop rate is typically 0.2 to 0.4%, and a 500,000 mortgage, 0.3% is 1,500 a year. Over a 5-year term, that's 7,500 for one phone call. The amortization extension is the move people feel guilty about, and I understand why. You're adding years to your mortgage, you're paying more interest over the life of the loan. That's real, but here's the cause and effect. A shorter amortization that strains your cash flow every month creates the condition for missed payments, credit damage, and in the worst case, a forced sale. A stretch amortization that lets you keep investing, keep your emergency fund intact, and keep your household stable. That's the actual win. You can always accelerate payments later when your income grows. Before you pick up the phone to call a broker, you need 5 numbers. Write this down. Number 1, your renewal date. Check your original mortgage documents or call your lender. It is usually the same month and day as your original closing, 5 years later. Number 2, your current outstanding balance. Log into your lender's app or portal. This is what you're renewing. Number 3, your remaining amortization. How many years are left? This affects your monthly payment calculation. Number 4, your prepayment privileges. Most mortgages allow 10 to 20% of the original balance as a lump sum each year. If you have any savings you could apply before renewal, this number matters. Number 5, your current payment. You need this as a baseline so you can calculate the exact impact of the new rate on your monthly budget. 5 numbers, 10 minutes. That prep turns a generic conversation with a broker into a specific, actionable one. They can run the exact scenarios for your situation, not the average Canadian. Today, pull your renewal date and current balance. You need both numbers. This week, get pre-qualified somewhere other than your current lender. Even if you don't switch, you now have leverage. Before renewal day, run 2 scenarios. One with your current amortization, one with it stretched. Pick the one your cash flow can survive a recession. The renewal shock isn't a market problem. It is a household cash flow problem. The Canadians who get hurt the most in 2026 won't be the ones with the biggest mortgages. They'll be the ones who didn't run the math 90 days early. Drop your renewal month in the comments and I'll do a follow-up video on the worst months to renew. Subscribe if you want the rest of this 2026 financial survival series. Recession proofing, TFSA optimization,